In this video, we're going to talk a little bit more about the marketplace itself, right? So what are the different types of markets? Well, a market is just a place, sometimes a computer network, but it's a place where we can exchange one asset for another asset. That's what a market is. I think everybody understands the concept of what a market is. But assets have a variety of different ways of classifying them. So we can talk about physical assets, things that you can touch, like cars and trucks and equipment, and financial assets, which are stocks and bonds. We can talk about spot markets and future markets. If you go to Walmart and you buy something, you are participating in a spot market. Spot market implies you're buying at the current time. A future market, though, would be a delayed kind of a purchase where you are investing today so that you can buy something 5 years from now. We also had mentioned money and capital markets a little bit earlier. Money markets are short-term securities. Capital markets are long-term securities. One of the things we do want to talk a little bit about, though, is the difference between primary and secondary markets. In a primary market, this is where we have new issues. So these are our initial public offering, or if currently trading companies issue new shares, we refer to that as seasoned issues, but these are new issues. And the reason this is important is that this is the only time that the issuer, the company or the government, receives proceeds from the sale of a security. The secondary market is every time the security trades after the first time. In this case, all the company gets is some information about who the new owner is, but they don't receive any proceeds. So the proceeds trades between the investors. Information is provided so we know who the new owners are. So if you think about trading, right, they refer here to as what two dimensions can we classify procedures? Well, we can classify by location, right? So this physical location, right, this is where we're trading face to face. This has historically been the way most financial securities are traded. We can also do it via the computer. So there's a couple of places where we can actually trade. We can also look at how buyers and sellers are matched, right? So if you're in a face-to-face trading situation on securities, we typically refer to that as an open outcry auction, that we have to verbally exchange information in prices and volume in our trading. Dealers, right, buy from and sell to clients from inventory, right? So they work kind of like a retail store. They have inventory on the shelf. They're either going to put more inventory on the shelf or they're going to take inventory off the shelf. Automated trading platforms try to match orders and execute trades without individual or personal kinds of interaction. So those are our automated trading platforms themselves. So we can also talk about how a transaction is to be completed. A market order means I want the transaction to happen immediately. So we just call up and say, buy me 100 shares of Apple. Whoever the broker is, they go, they find out where they're selling Apple, and they buy the shares for us. A limit order, though, we're going to put some characteristics or some variables, some factors on the security. So we're going to have a transaction, but only if it meets these criterion or this particular variables. So if we say, I want to buy if the price drops to $50, or I want to buy if it drops within the next 2 hours. If it drops to $50, I want you to buy it. So those are limit orders where you set the price when action can take place. A market order obviously happens immediately, but a limit order, we have to wait maybe for the price to change. So in this case, we might also have to have some instructions on how long to keep this order open. We could have an end of day limit order. At the end of the day, if the action doesn't happen, if the transaction doesn't happen, then this limit order dies. Or it could be good till, right? Keep this open until next week, right? So it's good till a certain period of time. Next, we want to talk a little bit about these broker-dealer networks, right? All broker-dealers are registered with the SEC, right? There's obviously a very regulated kind of industry. Again, broker-dealer purchases, they purchase stock being offered by a client, and then they want to sell it to another client. Again, we talked about this. This is kind of like a retail operation. Brokers that are part of the transaction, sometimes they refer to this as internalization. I don't think that's all that important, but this is where they have a very close relationship with the clients themselves. So again, trades can be with individuals, and we call them retail trades, right? Maybe 100 shares, 200 shares. And then there's large trades, sometimes with institutions. And sometimes, again, they refer to those as upstairs trades. I mean, some of these phrases, I got to tell you, I've heard of before, and some of these are not quite as familiar to me. An alternative trading system is when a broker-dealer, again, they have to register as an ATS, and usually this just has to do with automated trading. So again, if you have one of these systems that automatically fills trades, right, you are sometimes referred to as an alternative trading system. A little bit more of a secretive term, if you will, is to be called or referred to as a dark pool, right? So these ATSs, alternative trading systems, they report trades, but they don't provide any pre-trade information. So again, it kind of sounds like they're working in the dark. So sometimes it's referred to as dark pools. Now, stock exchanges are registered, right? They have to provide certain or meet certain criterion to be a stock exchange. Well, companies also have to meet certain criterion to be listed, right? So they can only be listed at a registered stock exchange. Now, they can trade other places in more than one registered exchange, but they have to be registered to trade on an exchange. And the criterion are not free. It's an expensive venture to get your stock listed on an exchange. You have to have certain kinds of sales, certain kinds of profitability. There's a lot of requirements that these exchanges have for you to be able to have your stock trade. And again, these exchanges, they have to provide trades, right? They also have to provide some pre-trade information. We need to know what the prices and quotes are coming and going in these stock exchanges. And finally, we really just have two primary domestic stock exchanges. We have the New York Stock Exchange, It's the oldest of the exchanges. Recently, it has merged with the American exchange. So, used to be three primary domestic exchanges. Now they're really just two. The New York Stock Exchange is a building, right? It's a physical place. The NASDAQ Stock Market is a computer network. So it happens out in computer space, right? So there's a lot more companies there. Typically, the smaller corporations are on the NASDAQ. The New York Stock Exchange has a tendency to have bigger stocks. So again, that's the end of this value. Talk a little bit about financial markets and how things might be traded. See you in the next video.